Hello viewers, welcome back to UPSC Warriors channel by Unacademy. So today we are going to continue our MCQ series on monetary policy. This is going to be your third video from this particular series. In the previous video, we have discussed in brief about quantitative easing. I hope you have all watched that video. If not, I would recommend you to please go and watch it, where we have discussed in brief about what is meant by quantitative easing as a unconventional monetary policy tool and how it is different from the conventional monetary policy tool, and what the RBI will be doing under quantitative easing and why it is important for us to know about it, especially after the COVID-19 pandemic and the economic slowdown that we are actually witnessing across the world with rising inflation. So before we begin, I have an exciting announcement to make for all of you. Unacademy is offering you one of the best prices for your UPSC CSE, that is just at 24,999. So you can use my code RIYA 50 to avail the subscription, where you have access to top educators courses in English and pure Hindi. So this is the second question. The following are likely to favor the effective monetary policy transmission in the economy. So what is meant by monetary policy transmission? Whether the measures taken by the Reserve Bank of the India to increase or decrease the money supply by altering the interest rates is actually working or not. Okay, that is something called as monetary policy transmission. The policy is getting transmitted to reflect in reality by achieving the desired goals. Clear? Okay, but in order to this monetary policy transmission to happen, we need certain conditions in place. If I am taking any measure so as to take care of something, if the measures are giving results, then obviously my benefit, my goal will be achieved, right? But in order to make it work, I have to take care of certain things in place. Say, for example, it is very simple. If I am using the banks to alter the money supply in the market, then whatever measures that I take, say, for example, lowering the interest rate, will be reflected only when the banks are in the proper working conditions. If the banks are already having problems like NPAs, then that is not something that is going to give me the positive result, right? So in order to this monetary policy transmission to get into effective, we need certain things in place. So this question is basically about the conditions which will enable the effectiveness of the monetary policy transmissions. Changes in minimum support prices. This is something that is actually done by the government, but still we are studying about monetary policy. But although we are studying about monetary policy, it is monetary policy transmission, and there are various things that happen in the economy impact the monetary policy transmission. So don't restrict yourself only to the actions of the Reserve Bank of India. And second thing is financial inclusion. So this is also true. If the government is changing the MSP in such a way that the MSP is going to encourage production, then obviously that will lead to increase in economic activity and growth. The farmers can go and borrow for enhancing their investments, and that borrowing again is going to favor the economy by we are going to offer them low interest. So this is going to encourage the production activity, and that is how the monetary policy is getting transmitted. So this is true. Talking about financial inclusion, of course, yes, we need bank branches. We need the banks to reach the masses so as to enable the favorable conditions of the economy. If the banks are not there, then how we can go and transmit this monetary policy mechanism in first place? So obviously we need bank branches, and that comes with financial inclusion. This is also true. And again, forward guidance is just one of the instruments that we discussed under the unconventional monetary policy measures, and this is also true. And loan waivers, if there are loan waivers, obviously that is going to help save certain set of money in the market, and that can be again added to the investments. So what is the correct answer here? But the statement is asking you to find out incorrect answer. So the incorrect option is none of the above. Let's see this in brief. See, monetary policy transmission, this can be your definition. It refers to the process through which changes in monetary policy instruments like repo, reverse repo, etc. are able to influence the demand, prices, credit availability, asset prices and consumption. So if something that is getting reflected on the field than only in the papers, then that is something that we can say monetary policy transmission has happened. And what are the factors that influence this monetary policy transmission? Availability of data. Obviously, yes, we have to make informed decisions. So as much as possible, the data should be readily available to all the stakeholders involved in this. And financial inclusion, that is something again very important. Bad loans and NPA issues. If the banks are already going through problems like NPAs, then definitely it is difficult for them to transmit the monetary policy. And fiscal policies like loan waivers or changes in MSP can also impact the monetary policy transmission. So how do the central banks ensure that the monetary policy transmission is effective in the country? It is by means of these measures. So what is the forward guidance? It is communicating the future policy intentions to influence the market expectations. So here the government, the RBI will be declaring about its future policy, its future chance, etc., so as to enable the market to plan accordingly. Addressing financial stability risk to ensure smoother transmissions, transparency and communication. So these are some of the measures regularly adopted by the Central Bank of India or any other countries to ensure effective monetary policy transmission. Okay, so it is done. Now moving forward to the third question, consider the following statements: decreasing interest rates, lowering reserve requirements, purchasing government securities by central banks. Okay, so remember what happens when government securities are purchased by the central bank. If the central banks are buying government securities, it means it is injecting money into the market. Remember, so this is something that is going to increase the money supply. Selling government bonds. So when the RBI is selling bonds, when the RBI is issuing bonds, what is happening when the RBI is issuing bonds? In return, what will happen if the RBI is issuing bonds? In return, it will get money. Clear? So this is something that is going to decrease the money supply. Now read the question. What is the question now? The question is asking you which of the above are the expansionary monetary policy measures. So under what conditions the monetary policy will be considered as expansionary policy is that whenever it favors way for increasing money supply, increasing demand, increase in production, etc., that is something called as expansionary policy. So this is something likely to happen when the inflations are under control. But now see, decreasing interest rate is again going to increase the lending, that can go will lead to increase in money supply production. So this is true. Lowering reserve requirements again will pave a way for the banks to expand their lending. This is true. Purchasing government securities will actually increase the money supply. This is true. But selling government securities will decrease my money supply. This is not true. The question is asking you expansionary policy. The answer is 1, 2 and 3 only. Okay. So here there is no option B, that is 1, 2 and 3 only. It is a very easy question, right? Moving on to the fourth question. Consider the following statements with reference to inflation. The inflation target is set by the center in consultation with the RBI once in every 5 years. Okay, was this the case? No. The headline consumer price inflation has been chosen as the key indicator. This is something true. Earlier this was not the case. This was not the case. Why? Because we have the MPC to do that, right? Fine. The question already delete panta. And moving on to the next question. Consider the following statements with reference to market stabilization scheme. It refers to buying and selling of government securities by RBI to regulate short-term money supply. Securities issued under MSP. Okay. That's it for today. Thank you so much for watching. We will continue the MCQ series on monetary policy in the next video also. If you have not watched the previous videos, I would definitely recommend you to go and watch it. Thank you so much. See you all in the next video. Bye-bye. Take care.